Have you ever wondered whether ETFs or mutual funds are better for your money? Choosing the right investment vehicle can feel overwhelming with so many options. Today, we will break down the key differences between ETFs and mutual funds. Understanding these tools will help you make smarter financial decisions. Whether you are saving for retirement or growing wealth, knowledge is power. I will show you which option fits your strategy and risk tolerance best. This guide is simple, practical, and easy to follow for any investor. Don't forget to like, subscribe, and comment to stay ahead in your investing journey. Number 10. What is an ETF? An ETF, or exchange-traded fund, is a collection of assets like stocks or bonds that trades on an exchange like a single stock. ETFs allow investors to buy a diversified portfolio without purchasing individual securities. They often track an index, such as the S&P 500, offering broad exposure to a market segment. ETFs can be bought or sold throughout the trading day at market prices. They generally have lower expense ratios compared to mutual funds. ETFs are tax efficient because of their structure, reducing capital gains distributions. They provide flexibility for investors to enter or exit positions anytime. Understanding ETFs helps decide if intraday trading or long-term holding suits your strategy. Number 9. What is a mutual fund? A mutual fund pools money from multiple investors to invest in stocks, bonds, or other securities. A professional fund manager makes decisions on behalf of investors, adjusting holdings based on research. Mutual funds can be actively managed or track an index passively. Unlike ETFs, mutual fund shares are priced once per day after market close. They often come with higher expense ratios due to management fees. Mutual funds can provide a hands-off approach for beginners who prefer professional guidance. They are suitable for long-term investors who prioritize simplicity and steady growth. Understanding mutual funds clarifies what role professional management plays in investing. Number 8. Liquidity differences. One of the key differences is liquidity, or how easily you can buy or sell shares. ETFs trade like stocks, meaning you can buy or sell anytime during market hours. Mutual funds are only priced at the end of the trading day, which limits immediate access. This makes ETFs more flexible for investors who want control over timing. Mutual funds are more predictable for those who prefer stable pricing and less market timing stress. Liquidity affects how quickly you can react to market changes. ETFs allow intraday strategies like stop orders or limit orders. Choosing based on liquidity depends on how active or passive you want to manage your portfolio. Number 7. Cost considerations. ETFs generally have lower expense ratios than actively managed mutual funds, which means more of your money stays invested. Mutual funds often include management fees and sometimes sales loads or commissions. Some mutual funds charge redemption fees for short-term withdrawals. Lower costs in ETFs can significantly impact long-term returns due to compounding. Mutual funds may justify higher costs with professional management or specialized strategies. Investors should compare total annual fees before committing. Tax efficiency also affects costs, with ETFs typically generating fewer capital gains. Knowing expenses helps you maximize returns over time. Number 6. Tax efficiency. ETFs are structured to minimize capital gains distributions, making them more tax efficient than many mutual funds. Mutual funds can trigger capital gains taxes when the manager buys or sells securities. ETFs use an in-kind creation and redemption process that reduces taxable events for investors. This makes ETFs attractive for taxable accounts where minimizing taxes matters. Mutual funds may be better in tax-advantaged accounts where capital gains are less of a concern. Tax efficiency impacts net returns and should influence investment choice. Investors need to consider personal tax situations when comparing these options. Making informed choices can save significant money over time. Number 5. Flexibility and trading. ETFs can be traded throughout the day at market prices, providing flexibility for timing entry and exit. Investors can use limit orders, stop-loss orders, and even margin trading with ETFs. Mutual funds do not offer intraday trading. Purchases or redemptions occur only at the day's closing price. This makes mutual funds simpler but less flexible for active traders. ETFs allow instant portfolio adjustments based on market movements. Mutual funds suit investors who prefer consistency and hands-off investing. Flexibility can influence both strategy and comfort level with market volatility. Choosing the right option depends on whether you want active control or passive simplicity. Number 4. Investment minimums. Mutual funds often require minimum initial investments, sometimes ranging from a few hundred to several $1,000s. ETFs, on the other hand, can be purchased as a single share, making them accessible for investors with smaller capital. Low minimums make ETFs ideal for beginners or those starting with limited funds. Mutual funds may offer automatic investment plans to gradually build positions over time. Minimums affect how quickly you can diversify your portfolio. Smaller accounts may benefit from ETFs due to lower entry barriers. Larger investors might not notice differences, but should weigh cost efficiency. Understanding minimums ensures your strategy aligns with your available capital. Number 3. Transparency. ETFs provide transparency because holdings are disclosed daily, allowing investors to know exactly what assets they own. Mutual funds usually disclose holdings monthly or quarterly, which can reduce visibility for investors. Transparency affects risk management and decision-making. Investors who want to track exposure closely may prefer ETFs. Mutual funds rely on professional management and research, which can simplify investing. Transparency also influences confidence in investment strategy. Knowing what you own reduces surprises in volatile markets. This can help align investments with personal goals and risk tolerance. Number 2. Performance and strategy. Mutual funds can be actively managed to try and outperform the market, offering potential for higher returns, but also higher risk. ETFs are mostly passive, tracking indexes for consistent, predictable performance. Active mutual funds may excel in specific sectors or market conditions. ETFs offer broader diversification with minimal fees. Strategy choice affects long-term growth and volatility. Investors must assess their risk tolerance and time horizon. Combining ETFs and mutual funds is an option for diversified portfolios. Understanding performance differences helps investors choose what aligns with goals. Number 1. Which one should you pick? Choosing between ETFs and mutual funds depends on your investment style, risk tolerance, and account type. If you want low costs, tax efficiency, and intraday flexibility, ETFs are ideal. If you prefer professional management, long-term simplicity, and steady growth, mutual funds are better. Some investors combine both to balance flexibility and management. Consider your investment horizon and financial goals carefully. Understanding your personal preferences is critical for successful investing. Consistent contributions over time outperform timing the market. Making a choice now ensures you stay on track toward your goals. A clear strategy reduces mistakes and improves long-term results. Investing is not about picking the perfect option, but about finding what fits your plan. Your money grows when you understand costs, taxes, and flexibility. Use these principles to make informed choices. Start small, stay consistent, and monitor progress regularly. Like, subscribe, and comment to share your experiences and learn more ways to grow your wealth. Smart investing begins with understanding the basics. Choose wisely, invest patiently, and watch your money work for you.